Well, joining us now is Christina Romer, former chief economist at the White House. She's currently an economics professor at the University of California, Berkeley, and a Bloomberg contributing editor. Professor Romer, always good to see you. Now, Paul Volcker, in his day, was a very controversial figure, but in retrospect, seems like he was a fairly successful Federal Reserve chairman.
Absolutely. And, I think that is such an important message to all keep in mind. Back when Volcker took control of the Fed, they were missing their dual mandate tremendously on the inflation side. And Volcker ended up saying, this gradualist approach isn't working. We need to do something big. He switched to money target. He said, we're going to do whatever it takes to get inflation down. And it was controversial. It did cause a recession, but it did solve the problem. And now I think many of us remember him as a hero for finally breaking the back of inflation.
And we actually, I used CPI as the proxy for inflation during that period of time. And you can see it went, from double digits, sort of low teens, down to what we would consider sort of a respectable level during the period of time in which he oversaw the Fed. Unemployment was neutralized, but it did increase. Now, if we look at today, inflation is quite low. So what would Ben Bernanke need to sort of take from Volcker's playbook?
Well, just as Volcker was missing the dual mandate on the inflation side, Ben Bernanke's Fed is missing the dual mandate on the unemployment side. So the inflation rate today is at or below the Fed's target, but the unemployment rate, we all know, is about twice what the Fed thinks is a reasonable long-run value. And I think that's exactly why Federal Reserve Chair Bernanke has to say, boy, we need to shake things up. What we're doing is clearly not working. We need to take a page from Volcker and do something bold, really convey to markets, to the public, we are going to beat this thing and we're going to get us back to a reasonable level of real growth.
So, Professor Romer, explain, connect the dots for us. How is it that if the Fed were to follow your idea, which is focus on real or nominal GDP, that somehow that's better than just focusing on unemployment?
All right. So the key thing about a nominal GDP target is it basically says, let's pick a normal year, maybe 2007, and say that nominal GDP should have grown at a reasonable rate since then. And the numbers coming out of studies by Goldman Sachs, almost everyone, sort of a number like 4.5%. And then what you'd say is, where are we relative to that? We're way below. And so the Fed would be saying, we're going to get back to that path, and then we're going to grow at a reasonable pace after that. The reason it's so good is I think, one, it can be very effective for changing expectations so that people understand where we're going. I think by making people expect more growth, we can actually get more spending today. But its real beauty is in the long run as well, because when you're back to that path, what the Fed's saying is we're going to grow at a normal rate. And part of that growing nominal GDP at a normal rate is a normal, sensible rate of inflation. So they'd have the same kind of inflation target they have today. And so the wonder of a nominal GDP target, it gets the Fed to do what it needs to do now to get us real growth, but it won't lose its credibility as a guardian of price stability over the longer term.
Now, Professor Romer, you point out a few other things that you think would also be supportive, and I have them listed up here. One is potential QE3. You also talk about just the language they use, more forceful promises. You talk about short-term rates, and you also suggest lowering the exchange rate. I mean, to what extent is the exchange rate even in the Fed's purview to manipulate at this point? And what do you think the likelihood is of another QE3?
All right, so certainly the way a nominal GDP target would work is it would both be a really strong communications device, but it also would lead the Fed almost surely to take additional action. So something like QE3, something like even maybe talking about the dollar. So you asked, is the dollar in the purview of the Fed? No, certainly what Ben Bernanke would say is the exchange rate's the purview of the Treasury. But that could certainly be something that between the two of them they could do, as we see Japan doing, as we see Switzerland doing, thinking about, what's really in the best interest of the United States in terms of the dollar. QE3, I think it absolutely needs to be on the table. As I've said, we're missing our unemployment part of the dual mandate so dramatically. The Fed needs to be thinking bold, and more QE3, a stronger communications policy about where the funds rate is going. all of that, I think, would be part of the toolkit, but all sort of motivated or working towards this goal of getting nominal GDP back on a sensible path.
All right, GDP growth and, of course, ultimately jobs for Americans. Our thanks to Christina Romer, former White House chief economist and now a professor back out in California.